All right, what's going on, everybody? So it's February 7th after the US market close. Today, I have the pleasure of speaking with Faisal, my compadre. He and I get to talk about markets quite often. It's kind of like, we often think of our conversations as what if we were able to have phone conversations and have someone just eavesdrop in. And so today's goal is similar to that, which is we're going to have myself, Faisal, and of course, our most important guest, our VIP, Austin. And we're going to be talking about 4 different topics with a timed discussion of all of us getting our points in. Topic number 1 is, what is the state of the market with respect to what happened in 2022? Topic number 2, recession, soft landing, higher for longer rate narrative, Jay versus Jerome Powell. Topic number 3, we got market performance in inflationary environments. And I think this is where Austin is going to shine. We're also going to be talking about liquidity and Fed polluting the investing environment, which is a very controversial topic of discussion. And topic number 4, what are sort of the narratives that are building up? AI, bank stocks, uranium, all kinds of cool stuff that we think is happening in 2023 and all that jazz. So let's get into it. Welcome, Faisal and Austin.
Hey, guys.
Hey, good to be here.
All right. So first things first, right? We talked about what is the state of the market with respect to what happened in 2022. So I'm going to let Faisal start this off. First of all, Faisal, how was 2022 for you? And what did you think about it?
Oh, I mean, 2022 has been pretty much good for me. I'll be honest with you. I didn't think that we were going to have this amazing of a start. You know, we've already wrapped up, an average year of gains in 1 month. I think we were up 9% in the S&P just in January. And, part of that kind of makes sense because you had such an overcorrected market in 2022 that now that you have these narratives of soft landing, recession odds coming down, you're going to have this type of excitement because there was just so much negativity in 2022.
and so now, jumping into 2023, now how are you feeling? I mean, huge pop in January.
Yeah, I mean, even after today, I'm not feeling that good about buying in the short term. I think things are a little bit overheated, especially after last month. But once again, you're coming off of an earnings season that was, the bar was already set very low, and most of the stocks, I think not most of them, a lot of them did beat. There were some misses, some beats on earnings and revenues, but the most important thing to take away from the earnings season this quarter was that the reactions to even bad earnings was very good. So a stock like, let's just say, AMD, I think had a pretty bad quarter, pretty bad guidance. Microsoft did not put out good guidance. Amazon did not, but the reactions were fantastic. I mean, the stocks had gone up well after those days. On the following days, they might have sold off on the aftermarket, but the next day they rallied. And so far you've seen a continuation. I think Apple, a lot of the key leaders, they had not so good earnings, but really good reactions. And that should tell you that, okay, maybe the most has been priced in, even though there's a lot of negativity in the backdrop. What I like to kind of reminiscent about is how were things during the COVID time? How we were very over pessimistic, and even as the earnings came out and they were kind of bad, these stocks would rally off of the bad news. And so it just feels like we're kind of on that upward trajectory where, once again, we had overcorrected to the downside. Now people are just starting to look up, even though things are still currently bad.
Yeah, and I'm glad you mentioned the COVID narrative because it seemed like back then it was almost like bad data and bad news was good for the market. Basically, the market kept ripping your face off if you were just too pessimistic. So I'm glad you mentioned that. We'll chime in on that a little bit more. So let's get Austin's viewpoint on this. So again, what do you think about the state of the market? Where are you right now? Position-wise, 2023, January so far, gone. Where's your head at?
Okay, well, let's start with COVID. During COVID, the global economy shut down, and the fact is, nobody knew how to react to it. And what the federal the central banks around the world, they decided one thing to do is just make liquidity just out of this world. And in hindsight, looking back, we overdid the liquidity part, and that's what ended up happening was that later on, the inflation just shot up like crazy, but you can't blame the central banks because this COVID event was unprecedented. Nobody knew how to handle this thing, but anyhow, so now we're looking at since COVID, we are paying the price for that over liquidity in the system, and it will take some time to get this thing back in order. So where I stand right now, I'm still very negative on the market. We're in a bear market, but I think it's going to take some time, maybe another year to year and a half to get this whole thing through the system. I always say that the rallies in the bear markets are just ferocious, and it makes you think that hey, maybe the worst is over, Yeah, so I'm still in that camp.
That's fair. And I do want to give a caveat. Austin is probably the biggest bull I've ever met. So when he says he's negative on the market, it means he's very serious about it. Okay, so topic number 2, we have all the negative factors that are coming about regarding recession and soft landing, higher for longer, and then this Jay versus Jerome Powell narrative, which I'll explain in a second. So first, I'm going to go off on this one. We've had, like Austin mentioned, a pretty rough go of it in 2022. Markets across the board were slammed. Equity indexes hit the sort of bear market threshold of negative 20% drops. Trash stocks and meme coins and everything got pummeled almost 80-90%. And I think that brought about, all this that was brought upon by the Fed basically raising interest rates, in the fastest pace ever recorded in history, if I'm not mistaken. So basically going from, zero bound to upwards of, 4.5%, right? And that caused the markets to basically, destabilize. But so far, so good. It's not like recession is a huge issue. Unemployment is still pretty strong, and the US economy seems extremely resilient and strong. And so the higher for longer narrative is, based on the fact that Jerome Powell believes, and Jay being sort of the, dovish Jay, and Jerome being the hawkish Jerome. I think Jerome believes that he will have to keep the higher for longer narrative, and he will talk markets down whenever he deems necessary. And in fact, the argument could be made that as the market goes up, Jerome has more narrative and more ammo to actually keep the rates to keep them from, or rather take them up higher, because the markets may not be properly understanding what the Fed can do and will do to bring inflation down. So personally, right now, the recession aspect, I don't really know at what point it's going to play out, but whatever happened in 2022, it seems like didn't really affect, the economy at large. We were still chugging along just fine. So what do you guys think about that? I mean, where is Jay Powell's mindset right now? What do you think for, the soft landing narrative? Do we feel like we've put the recession behind us? Do we feel like, okay, yes, it's higher for longer, but the market itself has bottomed? Let's start off with Austin.
Well, my take is that the inflation is going to be a lot stickier than what everybody thinks. It's going to last a lot longer. And if you read what Powell is telling you, he is doing everything possible to land this economy in a very soft manner. And he might succeed and he may not. Like you said, we still have a very healthy economy. There's still plenty of jobs. The whole thing is that, but he's still talking about 2% inflation target that he has, and
which seems like a long shot because, I think Stanley Druckenmiller has also stated that historically, we've never been able to get inflation down until Fed funds rate gets above inflation. So inflation right now being close to 6%, Fed funds rate around 4.5%, we have about 150 basis points of a delta, right?
I agree, and for that reason, I think that it's going to take a lot longer. And to me, it seems like he is committed to doing whatever it takes to hit his target, and that's why I'm so cautious. That's why I think that it's going to take another year to possibly 2 years to accomplish that goal. But don't take me wrong. I am very positive long term. I still think that during this period, we will see just a unbelievable amount of innovation start to happen. And on the other side, when we come out of this thing, when the rate cycle is peaked and inflation is in control, you want to be invested.
Love it. And I definitely want to talk more about the innovations because we do have a lot of different topics. People are thinking about what the next sort of investment theses and narratives are coming up. So we'll discuss that in a second. Now, I want to get Faisal's view on this because he and I have talked a lot back and forth about macro, soft landing, recession, all that jazz. So where's your head at, Faisal?
Yeah, it's really tough to say. I mean, I'm not one to I'm not an economist. I'm not trying to figure out things if we're going into recession or not, but I just kind of go along with what are the narratives, what is the sentiment going on in the market. And it's really strange to see how we went from, okay, there's definitely going to be a recession to now we're fine with the soft landing and higher for longer scenario within like a month span. And I think also that's probably because the jobs report keeps getting better and better. Earnings have been much better than expected, and you're not seeing that regression. You and I talked recently about what the downside was last year. When all these stocks sold off heavily last year, what did that exactly mean? It wasn't just a canceling of liquidity. It was also, in my opinion, a pricing in of some type of slowdown or recession. And even though you've seen a lot of these companies, the revenue has decelerated because there was a lot of pull forward, you're not seeing the type of earnings destruction that would warrant, these stocks have sometimes come down 60, 70, 80%. And so, like I said, I think even if we have a higher for longer scenario where interest rates are higher, you're still going to have a lot of stocks go up, a lot of sectors do well. You and I have talked about banking stocks doing very well because they've never had this type of scenario where interest rates are going to be a lot higher for a lot longer. And that new dynamic is going to help them bring in a lot more revenue. So there's going to be a whole change in leadership in terms of what's going to go up over the next year as we consolidate or get through this very rough period, just like Austin said, get back to normalcy. But I'm very optimistic. If you're an active trader, if you're an active stock picker, you will absolutely be able to find opportunities despite what seems to be a very shaky macro.
Yeah, I'm glad you mentioned the almost stock pickers mentality of a market that may be coming up upon us. So definitely for our listeners, look out for more episodes because we're going to, myself and Faisal, talk a lot more about what we think is going to be the environment for 2023, 2024, and what sectors of the market we'll be looking at more. So the other thing that we want to discuss is market performance in inflationary environments, which I believe is what we're in right now. And a side topic of that is liquidity and the Fed polluting investing environment. So I'm going to open this one up with Austin because I feel like he probably has the most experience given his decades of experience in finance. And I think he probably understands best how inflationary environments do for equity markets. So Austin, what do you think? I mean, inflation right now, I think we all agree on that, right? Seems very sticky. How do markets perform in this kind of environment?
Well, obviously, the dollar plays a very significant role in an inflationary environment, as the rate goes up, the dollar goes up, so that affects the earnings picture overall. But the growth really gets hurt, and because these risk assets, are priced into the future, and and so they have a very direct correlation to interest rates. And so if you think the interest rates are going to stay high or be even higher, the growth is affected quite a bit. But like Faisal said, that there are certain sectors that you can really benefit from. Even in the bear market, they're going to produce some results. And we were discussing earlier, I said, in an environment like this, banks seem to do really well, because as long as we do not have crash landing, higher rates, I mean, these people have not made any money on their mortgage loans or anything, because the rates have been at zero. So all of a sudden, even though the net margin rate is not that positive, but these banks can still make loans and make very decent return on their money. So this is going to be stock pickers market more than ever. In the last 10 years or so, it was just a momentum, driven by liquidity. So, but I think in the next couple of years or so, it's gonna take a certain talent to make money in the market, and you can definitely make money in the market.
Yeah, that's fair. No, I like that. We'll hold off on the discussion of bank stocks because I feel like that in itself is a whole separate topic of how bank stocks themselves can be a phenomenal investment in the current sort of crisis investing environment. But what I want to get your opinion on, and both of you guys, is this whole idea of, did the Fed sort of create a monster going back all the way to 2008 and 2009 when they effectively, sort of unleashed this low rate policy, and they sort of added, more and more liquidity to the environment. And then the blow off top was the COVID, unlimited ammo, right? Neil Kashkari, Jay Powell, they pretty much just went bonkers on everything. Do you feel like right now, given the environment that we're in, does a market hinge on almost every word that Jay Powell says? Because it's kind of like the Fed is talking. All the money in the world that's represented in investing markets is talking directly to you. And whatever Jay Powell says, good or bad, that kind of impacts market. So does that mean that right now, it may not be enough for us to just gauge companies' earnings or revenues or guidance on that information alone, because it either matters little or not at all because of what the Fed has done?
Yeah, no, absolutely. The next couple of years are going to be just fits and starts. You're going to have a lot of volatility. I always say, never bet against Fed. And what Fed is telling you is that they are committed to hitting their target no matter what it takes.
And the target being
2% inflation, and that's not a very easy target, so they are going to monitor the short term. We may have seen the peak in rates. Now they want to see how it affects the market, affects the economy, and to me personally, I think that the inflation is going to be a lot stickier than what the market thinks, and it's going to take a while. So to me, it seems like that in the third quarter or so, Fed may become more aggressive raising rates than what we see right now.
Fair enough. Faisal, I want to get your thoughts on this too, because we've often talked about this environment being really tricky. Today we were watching the Jay Powell Economic Council, talk. It seemed like the market was just whipsawing back and forth. What are your thoughts on, this whole idea of liquidity mattering a lot more now, and, Fed polluting effectively the investing environment?
I don't know if I would go as far as to say it's polluting it, but there's definitely a strong influence that, an FOMC meeting has, or whatever Jay says. that it has on the market. But I will say that what happened last year should not be discounted. There was a complete repricing of almost every single asset class. Like, you know, in 2021, we talk about all these tech stocks trading at all-time highs, 5-year PE highs, whatever. I mean, people forget that it was stocks like Home Depot. Your average sector stock, sector leader was trading at a 5-year high, and now we had a whole repricing. So when I look at the opportunities of today, I'm not just thinking, okay, I'm waiting for the Fed to give me the right signal. I'm also looking at, okay, in a historical context, if I still think that we can have some economic growth, there's going to be some softness of landing. What are the historical valuations that make sense prior to COVID? So, you know, I'm looking at 5-year PE ranges. I'm looking at, you know, for banks, you know, price to books, what are their relative norms? And even though, you know, you can say we were in a lower interest rate environment back then, you can still find companies if you're growing earnings or revenue, if you know, there are plenty of tailwinds out there. Like I've been a huge believer in industrials. There's onshoring of supply chains. That's a tailwind. There's another, the infrastructure bill. That's also another tailwind. You know, you have a lot of these themes playing out that'll supply this growth for the next 1 to 2 years, at least during the shaky environment. And I think those stocks have also seen a massive repricement. Well, actually, industrials have had quite a run recently. But, you know, you're still going to find opportunities like that. And I would just say, you know, go back to the historical norms. Price to earnings multiples are definitely better than price to sales multiples, because we're not going back to that era for quite some time. So that's kind of how I'm looking at it. And then, of course, you have to pay attention to the Fed speak, because that's going to affect the short term greatly.
I got something else to push back on, because it seems like we're sort of talking about the investing environment, you know, being a little bit tougher because Jay Powell is hell-bent on bringing inflation down, and he might break markets or break the economy in doing so. He's clearly stated that he doesn't mind actually, you know, bringing the economy or, you know, labor market down a little bit, right? Mm-hmm. So does that mean that, are we properly anticipating the earnings drawdown over the next, say, foreseeable future? Let's just say, you know, the next 18 months. Do you believe that, one, that's priced in? Two, whether you plug in, you know, in your DCF models, or you start looking at borrow rates in the current rate environment versus what could be anticipated 12 to 18 months from now, do you believe that the markets have properly priced that in, or do you feel like the market has pulled back in anticipation of 4 to 5%, but they probably don't understand what a 7 to 9% environment looks like?
That's an absolutely great question. I think that's the question that if you are an active trader, if you're a real investor, you're struggling with that question. What exactly is priced into the market? Now, like I've said, we've overshot it because that whole year of last year was just a crazy, absolutely one of the historically worst years. You're going to have this type of rebound like we've seen the last month. But I would just say, like, you know, you're going to get these ebbs and flows of these bull market runs. And for just to clarify, we are still in a bear market. I don't believe we started a new bull market. Just like Austin said, you're going to have these face-ripping rallies where sentiment kind of gets in this positive mode. Like I just touched on before, the earnings reactions, we're seeing some type of slowdown, but it's not enough to warrant the declines that we saw last year. And so you could say to yourself, okay, if this is the worst that it's going to get, yes, I think we definitely have a lot more upside to go. But if it will get worse, no, I don't know if that's priced in. I really don't know how to figure out if it's priced in, because one, I don't know the future interest rates. I don't know how aggressive the Fed's going to get. And two, I really don't know how the economy is going to land, whether it's going to be a hard landing or soft landing. So once again, I'm not trying to take any long-term trades. I don't do any long-term stuff because the long-term factors are too murky. I kind of more so stick with the short-term stuff, because those are the signs that are giving me the most clarity. And, you know, that's just my thesis on how to build around it, because you're right. Those are absolutely, you know, fantastic questions to think about. And you cannot make investing decisions based on, you know, the unknowable factors, but you can make short-term decisions on sentiment, how earnings are playing out and things like that, what the momentum is like. So that's what I would say about that.
Yeah, I like that. And I think one thing you, me, and Austin probably agree upon is that it is an increasingly tough environment to trade and invest in, and keeping it short term, right? Whether it's like week-to-week trades or month-long trades, it becomes much easier to trade that kind of range in terms of time, rather than looking at 3 or 6 months, because that seems,
You're
almost
playing a
impossible.
guessing game. I mean, it's so tough.
Literally a guessing game. So I like that. So the final topic that we have is, it seems like we've given people the idea of where our mindset is in terms of the market. We're playing it, on a week to week, month to month basis. We understand the environment that we're in, which is a tricky one. So what are you guys into nowadays? I mean, what's the theme of the week, the month, the quarter, the year that you guys are thinking about trading and investing in? I've heard, AI narratives are really taking off. I don't know how long that's going to last. Austin and Faisal have both mentioned bank stocks. We've talked about uranium, Austin and myself. And then, any other ideas? I'm going to start off with Faisal here.
Yeah, banks are, I think, they're showing the most short-term strength in terms of the structure of their moves. They seem to have a lot of resilience, and there's positive tailwinds behind them, and they aren't overextended. I would also say keep an eye out for the industrials, because just in case I am wrong, industrials are one of the first sectors that end up outperforming during a bull market, during the first stage of a bull market. And like I said, anything could happen. We could be wrong. We could very well be in the early innings of a bull market. I don't know. But once again, you've seen the price action to confirm that type of leadership. Stocks like Deere, which, you touched on AI. Deere is one of my favorite AI stocks. They also have a very good management, very good balance sheet and growth prospects.
And you said Deere won a lot of AI awards at CES?
They were the top winner at CES this past year. They won all the awards for their AI products. And you would think it would come from a tech company like Google or something else, but it was Deere.
That's crazy.
I mean, Deere is a phenomenal company. And, I don't know if they're buying back stock yet, but they've recently made a 52-week high, I don't know if an all-time high in the past month. So that should tell you just how well and resilient the stock has done. I don't know if these stocks have to cool down for a little bit, or if we do get a harder landing that they'll start to pull back, because business will pull back. But once again, like I said, the onshoring of supply chains is still going on, and the infrastructure bill still has to play out. You're going to have these companies have a lot of business regardless. So, I really like industrials, banks. And, if I can find something like Deere that kind of incorporates two themes that I like, AI and industrials, that's a win for me.
Is to extrapolate on the industrials idea. Do you feel like commodities, like say, I don't know, copper, gold, do you think that kind of falls in line with industrials because of the environment?
I would think so. But once again, I'm really not that experienced in commodities. I think that's a whole other game. But I do think that thesis plays out that, yes, if there's more economic activity in terms of the industrial production, things like that, industrial work, then yes, you should have raw commodities start to go up. It's like, more houses get built, the price of wood will go up, or if more, buildings go up, the price of steel should go up, things like that. If you see consistency in those trends, then yeah, that theory should play out. But once again, I'm not an expert. I really don't pretend to know, like I know that whole industry. So take that with a grain of salt.
Perfect. So, let's ask Austin here. So where's your view on, what's hot in 2023? We've talked about uranium. You got to speak with someone in the uranium sector, someone pretty important. If you want to disclose that, you can. What are your thoughts on, where 2023 is and how are you playing it personally?
Okay. First of all, as I said earlier, I'm pretty cautious over the next year to 2 years. But I also want to tell you, your listeners are probably a lot younger than I am. So your investment horizon is a lot longer than us guys in their 60s. Remember that these bear markets will end. I mean, by the time we see a soft landing or recession in the market, the markets are probably already recovered 50% of their loss. So the market is a discounting mechanism, and they would actually find a bottom 6 to 12 months before we actually have a recession. Okay, so keep that in mind, that market will sense that the enough is done. So trying to time the market. I mean, I was sharing a chart with Amo earlier, and I was showing him that over the last 60 years or so, an average investor's return is actually negative because we spend so much time in analyzing all the data and trying to figure out, whether we want to be long, short, this or that. And seasoned investors, what they do is they realize that the market doesn't just go straight up. It market also has drawdowns. So the key is to continue to do your research, find the right companies to invest in, and during bear market, you slow down your investing amount. You try to dollar cost average, instead of buying your whole position at one time, you break it down. And I guarantee you that this bear market is going to end one day. And when it ends, you would not be able to get back in because the market has already recovered 50-60% from the low. So psychologically, you just can't handle that. People cannot handle it, and they will wait and wait and wait until the market is at the top again, and then they will jump in, and which will be the wrong timing again. So to me, it is an opportunity for young investors to understand how the investment world works. Nobody's going to ring the bell at the bottom, and nobody's going to ring the bell at the top. So you need to do your work and find the right companies. Where am I finding opportunities? Like Faisal said, banks. I also would add insurance companies. Remember, insurance companies take your premium and they buy bonds. They invest that money in secure instruments. As the rates go up, their return, your premium that they're taking in, they're getting much higher return than they did 6 months ago.
Any particular insurance companies that we should be looking at?
I was looking at Chubb. So some of these AAA rated insurance companies are well-managed companies. There's the ETF for insurance companies you can buy. So this is an ideal time for these insurance companies to make a lot of money. Also, I am, we're talking about AI. I'm very positive on that. You want to be investing in semiconductor companies. Semis.
Your NVIDIA's, AMD's, ASMLs.
Absolutely. I was talking to Faisal earlier. I said that ATI CEO was on CNBC today. He said in the next few years or so, consoles are going to be obsolete. People will be playing videos on their TVs, and the chip companies are the one that are going to provide that transition.
Amazing.
So these companies, all these console companies will turn into focusing on software.
You're talking about video game consoles, right? Like you won't need an Xbox or a PlayStation. You will just need the TV, and it'll just play it through that, correct?
Exactly.
That's incredible.
And the experience will be 100 times better than what you get from your console.
Wow.
So
and it saves on costs as well as management of devices, right? Because you just have one big device, your TV.
Exactly.
It does everything.
Exactly. And it'll start another cycle for PCs and TVs where and another area that I think that investors can pay attention to is there's a lot of shortage of workers right now. And a lot of industrial companies, like you said, Deere, they're using robotics more than ever, and the companies that are in that industrial automation area will benefit tremendously, like Rockwell. They make these robots for Amazon and so on, to automate their factories. So there are a lot of opportunities, and personally, I think that software is going to be a little hard to invest in this time frame, but I continue to hold Microsoft of the world, because I think this is a core position for me. I'm gonna stick to it, but I may not invest anymore for the time being. I'm very bullish on semiconductors. I'm bullish on automation. I'm bullish on insurance companies, banks, and so on. So I think that's where the opportunities are. Don't be discouraged. Don't be disheartened. Focus your time on finding good companies and build your portfolios. And wait for the time when the bear market is over, and then you're going to reap the benefit.
I love it. Well, I think that's a good area to stop, because I feel like that was a very fruitful discussion. Yeah, thank you guys again for your time. I hope we can do more of these, because it seems like, first of all, people like it. And especially given the current environment, how tricky it is, it's almost better to have this back and forth of sharing ideas, sharing thoughts of where we are individually, and then how collectively, we can sort of share this information with people that are listening, and how they can make a informed decision for themselves. Again, we don't provide financial advice, so please consult your financial advisor. All right, take care, everybody. That's it for us. Cheers and thank you.